Welcome back, everyone, to another explainer. Listen, if you're a BSc, CTA, or SAICA student gearing up for your tax exams, you already know that mastering the South African Income Tax Act is honestly like learning to play a high-stakes game of chess. Well, today, we're going to completely demystify Section 10 of the Act. We are looking squarely at exempt income. We're going to break down those highly specific provisions that take amounts already caught in the gross income tax net and legally pull them right back out. Let's get into it.
All right, here is our roadmap for today's session. Number 1, the income formula. Number 2, cross-border and withholding exemptions. Number 3, personal and social support. And finally, number 4, employer incentives.
Okay, kicking things off with Section 1, the income formula. If you take absolutely nothing else away from this masterclass, please remember this fundamental rule. An amount must first be included in gross income, whether that's through the general definition or a special inclusion, before we can even begin to discuss applying a Section 10 exemption. I mean, you literally cannot exempt an amount that was never in gross income to begin with. So, in your exams, always explicitly show that gross income inclusion first, and only then deduct the exempt income to arrive at income as defined. Just remember, exemptions are not deductions. They are specific legislative shields.
Moving right along to Section 2, cross-border and withholding exemptions. Let's look at Section 1011L, which deals with South African source royalties paid to non-residents. Notice the clear legislative distinction here between a natural person and any other person, like a company. Now, this is a classic exam trap, so pay attention. For a natural person, the exemption applies unless they were physically present in South Africa for more than 183 days in the preceding 12 months, or if the intellectual property is effectively connected to a South African permanent establishment. But for a company, only that permanent establishment rule applies. Let's think about a real scenario. If a non-resident individual is physically present in South Africa for 200 days in that 12-month period, bam, the exemption completely falls away. They're going to be taxed. But if they were only here for 100 days, the royalty remains fully exempt from normal tax. You absolutely must check those days.
What's really fascinating about this part of the legislation is how elegantly it prevents double taxation. If our non-resident from that previous example triggers the 183-day rule and their royalty becomes subject to normal tax, this provision ensures they won't also be hit with a royalty withholding tax. The Act ensures SORS gets their slice of the pie for sure, but they do not get to eat the exact same slice twice. Staying with that international theme, Section 1011LA looks at foreign entertainers and sportspersons. Imagine a huge international musician flying in to play a massive stadium tour in Cape Town. The logic here is so elegantly simple. Their earnings are exempt from normal tax precisely because they are subject to a final withholding tax mechanism under Sections 47A to 47K. The exemption kicks in specifically because the withholding tax has already done all the heavy lifting of tax collection. Next up, Section 3, personal and social support exemptions. Section 10(1)(u) deals with alimony and maintenance. If a divorced spouse receives monthly maintenance, it is first included in gross income under paragraph B of the special inclusions, but then it's immediately exempted here. But wait, you have to highlight this highly specific date criteria, 21 March 1962. It is an absolute, non-negotiable condition for this exemption to apply that the proceedings instituted or the separation agreement entered into occurred after this exact date. And a quick reminder for the paying spouse, there is no deduction allowed for them. Examiners love to test if you're actually paying attention to the fine print. Then we have Section 1011MB. This one is a wonderfully straightforward, absolute exemption. If a hardworking employee is unfortunately retrenched and they claim a benefit under the Unemployment Insurance Act, that full amount is completely exempt from normal tax. There's no monetary limit, no complex calculations. However, a crucial technical distinction for you SAICA students, this applies strictly to benefits under the UIF Act 63 of 2001. Private unemployment insurance policies, nope, this doesn't apply to them.
All right, now we hit what I like to call the G series. It's essentially a barrage of specific subsections dealing with trauma and compensation. Notice how all these payouts, whether it's a war pension or mining disease compensation under paragraph G, a disability pension under the Social Assistance Act in paragraph GA, COIDA workman's comp in GB Roman numeral 1, a pre-1994 occupational disablement pension or road accident fund compensation, they are all completely shielded from normal tax. The legislation recognizes that taxing these very specific compensation payouts would totally defeat the purpose of the social support they're meant to provide.
So, why the strict focus on a 300,000 Rand limit? Well, this monetary limit applies strictly to Section 1011G(b)(3). If an employer pays compensation in respect of the death of an employee, specifically arising out of and in the course of their employment, the exemption is strictly capped. For example, if a company pays a grieving family 400,000 Rand as a death benefit, the first 300,000 is fully exempt. The excess 100,000, that remains taxable. Whatever you do, do not mistakenly apply this 300,000 Rand limit to the other G-series exemptions we just talked about. Wrapping up the G-series, we have a very specific carve-out, Section 1011GD. This explicitly exempts funeral benefits. But take very careful note here. It applies strictly to benefits payable in terms of Section 6F of the Special Pensions Act. It is not some blanket exemption for just any private funeral policy payout. In your exams, precision in citing your authority is key. And finally, Section 4, Employer Incentives. You know, the tax code actively works to encourage positive corporate behavior. Section 1011S deals with the Employment Tax Incentive, or ETI, which incentivizes employers to go out and hire young, inexperienced workers. When an employer qualifies for this, they actually get to reduce the PAYE they owe to SARS. Now, without this specific exemption, that reduction in liabilities would theoretically be included right back in their gross income and taxed. This exemption completely shields that ETI reduction. Now, while we're focused on the employment relationship, there are two more crucial exemptions you absolutely must master before you write. Uniforms under Section 1011N and relocation benefits under Section 1011NB. For uniforms, an allowance is exempt only if wearing that uniform is a strict condition of employment, and it's clearly distinguishable from ordinary everyday clothing. The trap here? Uniform allowances aren't initially included in gross income. They are included in taxable income via Section 811A and then exempted. So if an employer simply provides a branded uniform, it's fully exempt. But if they hand over a cash allowance that exceeds the actual cost of the uniform, yep, that excess portion remains fully taxable. As for relocation, Section 1011NB completely exempts costs like transportation, the selling costs of an old home, and settling in costs provided the employer actually bears them. Hotel accommodation is also exempt, but strictly up to 183 days. If an employee stays 200 days, those extra 17 days are going to be taxed. Oh, and architectural fees for new residents, or just a general lump sum allowance not tied to any actual costs, those are taxed in full. We have covered an immense amount of ground today. So I leave you with this thought. Which of these Section 10 exemptions will catch you out in your next gross income calculation? To make sure you don't drop a single mark, let's run through a rapid-fire master exam scenario. Picture an integrated question. A non-resident musician comes to South Africa, receives a royalty, stays for 200 days, gets an ETI-backed support staff, and then relocates here permanently. How do you tackle that? First up, exam technique. Always show your gross income inclusion before applying any exemption. Because our non-resident was here for 200 days, the Section 1011L royalty exemption falls away entirely. Tax that royalty. For the musician's performance income, the Section 1011LA exemption applies perfectly because they are subject to withholding tax. When their support staff relocates, you'll exempt their transportation and up to 183 days of hotel stay under Section 1011B, but you will tax any general lump sum allowance in full. Let's finish up with your ultimate revision checklist. Section 1011L royalties. Check those physical presence days and permanent establishments separately. Section 1011LA entertainers, check for withholding tax. Section 1011U maintenance, make sure the date is strictly after 21 March 1962. The G series, remember the strict 300,000 Rand limit on employer death benefits under G Roman numeral 3. Section 1011MB, UIF Act benefits are completely exempt. Section 1011S, ETI reductions are totally shielded. Section 1011A, uniform allowances, remember they go through taxable income, not gross income. And Section 1011NB relocation, actual costs are exempt, general allowances are not. And our golden rule for the day, exemptions are never deductions. Keep practicing those integrated calculations, and I will see you in the next explainer.